you're going to also be seeing a lot more business transitions over the next decade. And there's going to be instances where there's not going to be a real estate component, but there's a highly successful, profitable, well-margined operation that someone may want to acquire or do a buy-in of. It's existing employees potentially. And being able to navigate that effectively is going to be super important, just as a general comment for the Canadian economy. So I think we even had one example recently where there was a client who was very, like 10 million plus in revenue a year. They were looking for about 3 million-ish when it comes to expansion financing. And so they had a bunch of stores, locations already that they're operating out of. They were all leased locations. They didn't own any of these spaces. And in order to expand, they wanted to utilize some debt capital to do that, but they weren't being able to get the support that they wanted from their incumbent lender. And the reason is because
at MBA Chartered Professional Accountants, we have 3 core beliefs. 1, we believe that business owners are the most important people on the planet. 2, we believe that the traditional accounting firm business model is flawed and fails to serve you. And 3, we believe the MBA way gives you what you truly want and deserve, resources and advice that helps you grow your business and your life. This is the MBA Way podcast. Hi, everyone. It's Eric Solbach, and welcome back to the MBA Way podcast. Today on the show, I have Brian Stephenson here, and the title of this episode is your debt working for you? We had a great conversation when we first met, and I was thinking, I really have to get this guy in front of our audience so they can understand exactly what they do. Brian is a co-founder of Lakepoint Capital Partners. It's a commercial lending specialty firm, and it helps business owners like you, commercial investors and developers structure and source debt that works for them. Brian, welcome to the podcast.
Thanks for having me, Eric. Appreciate it.
So we were having a little chat here just before, and we were talking about the fact that you're a new dad.
Yeah.
And so you got to do a little shameless plug here. Tell the listeners.
Yeah, for sure. We're very lucky. We have a 5-month-old named Sophie who has been keeping us busy, but also been very kind to us. She sleeps great, eats great, poops great, no issues at all. And we're also very fortunate. We live in town with both sides of the parents, in pretty close proximity. My mother-in-law actually lives in our basement suite, so we're not lacking for support. So I'm very fortunate.
That's awesome. It's funny because whenever I do these podcasts, we end up coming up with kind of new thinking and new ideas, and it's great because it's interactive. And I always have this magic of 3s. I end up coming up somehow. There's this magic with 3s, and there's always 3 points, and you've already hit those 3 points. She eats right, sleeps right, and poops right. Like there's our magic of 3s. We're done. We don't have to do any more of the podcast. We're finished.
Exactly. So no, we're good. But I appreciate you having me on and being willing to kind of let us share some stuff with your audience. And it's been an interesting journey to kind of get where we're at. We're about just over a year and a half into this now. And this being Lakepoint Capital. And so just for background's sake, I guess, for yourself and the audience. So I'm a lawyer, used to be a partner at a full service law firm here in Kelowna called Pusher Mitchell. And I had a practice that was largely commercial financing orientated and focused, and there were some business transactions and a bunch of real estate in there as well. But that was kind of the background that I came to Lakepoint with. And the genesis of our business is really from my business partner, Cooper Harrison. So Cooper has an interesting background. So like yourself, a recovering accountant. So he was at Grant Thornton where he got his CA, and then went over to Bank of Nova Scotia in the commercial team for a number of years before joining an organization called Decisive Dividend. They're local to Kelowna, but publicly traded on the TSXV and doing quite well. And they're essentially an M&A organization where they'll buy. They started with a focus in manufacturing and ventured out a little bit from there. Companies inject a bunch of expertise, capital, and kind of spit out dividends from improved operations of those entities. And so I think they're at 12 or something at this point. But the reason I give that background is because it was in the course of Cooper's experience working at a bank, being a lender, and then working at Decisive and helping that entity acquire financing to make acquisitions, that he realized that there's definitely a gap in the market when it comes to what we do now, which is corporate debt advising. So when Cooper was working at Decisive, he got a lot of exposure to business brokers bringing different opportunities to Decisive for acquisition purposes. And there's a whole range of kind of quality, let's say, of these SIMs that would be brought forward, or these opportunities to purchase. And in looking at all of the, let's say, the higher quality ones, he noticed a trend that he thought could be very replicable in the debt space. So instead of selling a business, sell debt. And so that was essentially the start of the idea. And given the fact that between both of us, we've kind of sat on all sides of the table when it comes to borrowing, lending, buying, selling, advising. And so we thought it would be a worthwhile endeavor to start Lakepoint and use our skill sets. Now we're both kind of jumping ship from some pretty established positions to do so. But again, we saw an opportunity that we feel like is fairly blue ocean. We're not the first ones to do this, but we're definitely unique in our localized market. And I think even in the broader context of the province, we're a pretty unique professional team. We have another team member, Carolyn. She used to be at Van City Credit Union. So she's a CPA as well. So have strong accounting skills on our team.
You're surrounded by too many CPAs, man. That's a bit scary. It's a bit scary.
They're the smart ones, though. They're the brains of the operation, so you got to keep them around. But anyway, so sorry, I know I just started off and started rambling on you there, but that's kind of the background for us.
No, it's great, man. You just, I didn't have to do anything. I just sat back and you kind of went right into where I was going to go. Like say, well, tell me a little bit more about Lakepoint, and you shot off with there, and I wanted to find out a little bit more about your background, and you shot into there. I love the fact that you're a recovering lawyer. Having an interview with a recovering accountant, and your partner's a recovering accountant, and you've got another team member who's a recovering accountant. It's curious how our life experience culminates in what we think we're supposed to do. Like, so you do the traditional route and you follow that traditional route, and then all of a sudden something catches your eye, something catches your attention, and all of a sudden you're like, hey, what is that? It's kind of outside the mainframe, outside the fold, shall we say, of the traditional professional track, right? And then all of a sudden it's like, if you actually see what really intrigues you and gets you excited, and you start following that, you can create something totally brand new and different. Like you and I talked about it, the accountant success formula was the thing that I did for me, and I ended up, creating that new coaching model and the new practice. Totally brand new, and went to market. Now you're doing the same thing, taking your expertise and creating something in Lakepoint Capital. And so I'm really curious, because we had a great conversation the first time we met, and I was like, this is great, man. Like the title of the podcast is your debt working for you? And that's been ringing through my head over and over again, because, debt has always seemed like a 4-letter word to people. Right? Oh, got to get rid of debt, especially my parents, my parents' age. And, my parents are, they're in their mid 70s now, 70s, late 70s, early 80s. And so debt was a bad thing. It was a 4-letter word. You got to get rid of the debt, But as business owners, it's about making the debt work for you. So I really like that hook on, is your debt working for you? And I want you to share a little bit more about that, because I'm curious to hear more about how you get debt working for your clients instead of it working against them.
Yeah, no, totally. Well, it's funny that you mentioned that background, just briefly touched on. So I come from a family of teachers, and I was clearly remember the story of my dad's parents having a mortgage burning party kind of thing, because they were so excited to have paid off their mortgage. And so, and as teachers, my parents were both fiscally responsible but also debt adverse. And anyway, so that's a side note. And I think to touch on what we're doing here, it's interesting when you talk about being recovering professionals as well, because I have to say, I now, having been doing this for the time that we've been doing this, I think if I were to go back to law, which I have no intention of doing, I would be a much, much better advisor for my clients. And I think so. The only reason I say that is because I was thinking as you were talking, is that I think there's a lot of benefit for people who have been able to go through that professional track, get that kind of industry or let's say practice experience within a firm, And then if they can get as much exposure to kind of the realities of business, I think there's a lot of value that can be derived there. So, for example, when we're working with some of our clients, it's very interesting now being a purchaser of legal services, now being on this side of the table, and how important it is to just be a responsive lawyer. Because if you may be the smartest guy or gal out there, but if your clients can't get in touch with you and get an answer from you, then you're not worth anything to them in the business context, because things move very quickly these days. I would rather have the guy who got the A minuses in class versus the A pluses, as long as the guy with the A minuses can actually pick up the phone and respond to you. And so it's been very interesting to be on the legal purchasing side of things, professional services side. So yeah.
Isn't that something, I used to call it the ivory tower syndrome when I had my first accounting practice, is that there was all these professionals and they were in their ivory tower. And then the business owners, you'd come to the ivory tower, you go up to the top, you open up the big gates and you walk up to this, this professional that's sitting in the ivory tower. And this ivory tower professional is telling you what you need to do for your business and how to do your business and all that stuff, when they had no bloody clue how to run a business, no idea how to start a business, no idea of all the other 4,000 things you have to worry about all the time being a business owner. And so, again, this is why we have such a different viewpoint from MBA, is that for myself, I had to restart my entire practice. So I had my first 18 years in a traditional firm being that ivory tower guy. Okay. I was that guy. Like, the reason why I can talk with such passion about it and poke fun at it, because I was that asshole. Like, I was the guy sitting there thinking that I had no idea what I was talking about. Right. Then I crashed. I had to start my own practice. So I had to start from scratch and build it, put the chairs together, all together, and build from the ground up. And then all of a sudden I was like a way better advisor to my clients, because I was just like them. I was a business owner. And my business partner, Peter, is the same thing. He came to Kelowna, had nothing. There was nothing here, and he started it from scratch, And, there's also something to be said about some life experience in there as well, where we've had some ups and downs and personal crashes. And, I wouldn't wish it on anybody, but I mean, divorces and partnership breakups and all these different things makes you more empathetic to the clients. You understand them more. And so you can think like a business owner. And that's what we say at MBA, is like, we think and act like entrepreneurs. We think and act like business owners. We got to put ourselves in the shoes of the person you're advising and say, okay, if this was my business, what would I want? What would I want for it? And so I love the fact that you've tied that in as well.
I totally understand it. And to kind of more appropriately, maybe, or directly answer your question when it comes to the debt usage side of things, it's very interesting how our business itself has evolved. Because when we first started, open the doors and we're willing to take kind of all comers at the early stages, just trying to kind of get the ball rolling. But we very much found our groove now working with kind of three main client types. So it's established, successful businesses, commercial real estate investors, and developers. And I think for the purposes of likely your audience focusing on the business owner side of things, what's so interesting is that you'll have operations that sometimes have commercial real estate components, because business owners have diversified some of their investments or acquired the space that they're operating out of. And real estate in Canada is a very easy, or much easier, asset class when it comes to the financing piece. A mortgage security is very kind of straightforward and understandable to banks and lenders and borrowers and usually everyone involved. What's interesting is that I think where we've been able to provide even more value to clients is where there's just cash flow based lending. So there's no real estate component. It's purely upon the operations of the business. And so we found quite a bit of success in that space as well. And we've worked with clients that have a variety of different assets that they can secure against. But I think the cash flow lending side of things is particularly interesting because you're going to also be seeing a lot more business transitions over the next decade. And there's going to be instances where there's not going to be a real estate component, but there's a highly successful, profitable, well-margined operation that someone may want to acquire or do a buy-in of. It's existing employees potentially. And being able to navigate that effectively is going to be super important, just as a general comment for the Canadian economy. So I think we even had one example recently where there was a client who was very, like 10 million plus in revenue a year. They were looking for about 3 million-ish when it comes to expansion financing. And so they had a bunch of stores, locations already that they were operating out of. They were all leased locations. They didn't own any of these spaces. And in order to expand, they wanted to utilize some debt capital to do that, but they weren't being able to get the support that they wanted from their incumbent lender. And the reason is because the incumbent lender wasn't able to reach for a real estate asset and thus was struggling a little bit with how to make this work. And so that's kind of where we came in. And I think a big outcome that we were able to get for them was based upon again, using the professional backgrounds that we have. We did some compilation of some consolidation of some financial statements across multiple entities. We're able to do projections for them. We're able to really understand their business. And again, this is all credit to my business partner, Cooper, because with his time at Decisive, they saw so many different types of businesses and were able to, going through the very lengthy due diligence process that they have, we're able to identify so many different areas where they can get hung up on from an operational perspective, in addition to looking at it from a lender's lens, and which is super important because lenders don't participate in the growth of a business. They don't get, if there's an upside, that's not there for them. All they get is the downside if they don't get their money paid back. So they're very risk orientated. So understanding how to communicate with lenders has been such a huge part of this job, frankly. It's our job is to communicate to lenders in a very effective way why this is a good idea for you to lend on this and why you should come to the table as competitively as possible. That's why we exist. Get them the best debt that's available in the market. In order to get the best debt, you need to have a competitive situation. You need to know what to ask for, who to ask it from, and how to ask. So, anyway.
So you just said something there that sent a light bulb off for me. We're talking about like the technically proficient advisors. So we'll call it lawyers, accountants, bankers. We'll call those three. Well, a lawyer, an accountant, and a banker walk into a bar, right? We'll start a joke like that. But there's those three, and they have their technical. They're in their heads and they're technical, and they've got all this technical piece. But the real magic in business isn't like you need the technical knowledge to be able to traverse this and do it. But it's being able to have the actual personal skills. Again, probably the accountants are probably the worst out of those three professionals of being able to actually have a personality and talk to somebody, right? But actually to be able to talk to the client or to the stakeholders. In this case, you're having the conversations with the lending facility, the lending institutions that you're working with, to be able to tell the story, to be able to have the right conversations, to be able to talk to the client, to explain them what we're doing with this reorganization or why we're doing this estate plan, or, it's all in the interpersonal relationships. And I find that our whole push, say, industrial push, is moving more and more to outsourcing all the technical and automating the crap out of everything, right? AI this, automate that. Now, don't get me wrong. This is all great stuff. And it's great because if you use the AI tools right, it's an incredible tool. If you let it use you, you're the tool. That's another story altogether. But it's in the interpersonal relationships, and it's having the right conversations to be able to make transactions happen, to get solutions across the goal line. So you're having those conversations with the lenders and saying, look, this is a great company. They have great potential. They can easily service this debt. But under the traditional quote unquote, and I'm doing air quotes for those people that aren't watching the video here, they're listening, on paper, when you look at the individual financial statements, they just go, it's not there. We can't lend on it because it doesn't fit in their in the template, shall we say. Then you guys come in and go, no, look, let's pull them all together. Let's consolidate. Let's look at it differently. Let's find out more about the business. Let's talk about the story. And then you have that right conversation, and then you can get them the right lending they need to move forward. So it's this personal relationships that are so critical and so important. And which is another reason why I love doing the podcast, because then I get to have great conversations with people like yourself and create more relationships and bring more value to our listeners to say, and this is exactly one of those points, is like, it's about the personal relationship, right? It's about having the right conversation, about understanding what the client really wants to get and then making it happen. And so, and there were so many points in there. I could run down so many roads there, but I just had to encapsulate my thinking around that. So you then, so who are the people that you're working with? I'm curious on that part. Like, who are the lenders that you're like, because let's say the client comes in, they're going to a traditional bank and they're going to their additional bank, which, by the way, a lot of bankers piss me off because like you can be with a bank for years and years and years. And all of a sudden you go there. Like I was going to buy my commercial property when I had my second accounting firm and I went to go borrow some money from them and they treated me like garbage. So I went, this is ridiculous. I walked across the street and got another banker. But who do you work with? So like I'm going to my regular bank and my banker says no. And I'm like, oh, okay, well, I guess I'll go. Next step is go BDC, right? Like that's kind of the two options that most business owners go, well, I went to the traditional bank and it said no. I guess I can go, if I even know about the BDC, I'll go there, which is, I find sometimes legalized loan sharking. But anyways, I'm jokingly saying that because I'm actually going to have someone from the BDC on the podcast coming up soon. So I got to poke some fun at them now. Yeah. But who are the people that you're going to get the financing for? Because I'm curious about that.
Yeah, no, for sure. Well, it's interesting. So I think over the last 40 engagements that we've had, we've brought opportunities in front of, I think, 120 different lenders, some odd like that.
Wow.
But the thing I really want to emphasize is the reason that number is so high is because there is a very large private, I'll refer to them as private institutional because they're not private high net worth individuals. It's organizations that do this as a business, private lenders in the real estate space in particular. So I want to emphasize for business owner clients, the landscape is a lot more constrained when you're doing stuff like cash flow lending, like I referenced before. Whereas if it's real estate based, because the Canadian economy and Canadians understand real estate so clearly, comparatively, there's a much larger landscape for that. So, but to answer your question, we collaborate a lot with banks and credit unions, and we also collaborate a lot with clients who have very long-standing existing lending relationships, because we're not here to just save the fringe businesses that are struggling, can't get any sort of debt type of thing. Our expertise is actually much better served for those businesses that have been in operation for 10 plus years, have 30 plus employees, are doing 5 to 30 million in revenue, like some very established entities, but they have they're very busy. The business owners are still busy in the business. They may not have a specialized finance function internally. And even if they do, even if they have a CFO, the thing is we see 100 term sheets a year, for example. And with the commercial real estate or commercial lending market, there's a lot of opacity when it comes to, okay, what are not just rates, but what are kind of market terms, and what sort of flexibility could you actually negotiate within this structure, and what sort of leverage is available out there. And because we see so much, we have that volume. We are able to make much better recommendations and take much stronger negotiation positions because we're aware of what RBC, BMO, CIBC, TD are all doing, and we can bring them to the table because, going back to your relationship comments, we also know who within those institutions are the right people to be talking to. As we've built relationships within those organizations very intentionally because we know kind of who has the ability to get a bit more creative with the deal, to be able to push on credit a little bit more, has seen a bunch of different Lakepoint Capital requests for financing come in, and so understand us from a credibility perspective. They know that we bring forward good deals. We know that we bring forward good work, because our job ultimately is to make the lender's job as easy as possible. That's how we get a client a good result, because the lender, we want them to look at our package and say, I understand this story qualitatively. I understand this story quantitatively. I want to be a part of this, the success of this business. We want to fight for this deal because we've already had all the risk factors mitigated by what Lakepoint has told us within this package and supported with the other evidence. We don't just take information from a client, just shotgun it out to the world and say, hey, 120 lenders, someone give us something. It's no, we're going to go very specifically to a select number and we're going to run the process with that. Kind of lost my train of thought. But at the end of the day, I think what I want to emphasize is that when it comes to the relationship side of things, our clients already have existing banking relationships. That's how they've gone to the size that they've been at. And we are respectful of that for sure, but we're also mindful of how the competitive landscape changes for these commercial lenders at a rate and in a background where the business is just going to keep doing their business. And they're going to assume that their bank is bringing forward the very best deal available in the market. But the thing is, their lender may not be able to do what other lenders can do. So that's not even an option being brought forward to them. And the second point is, it's often the case that if you don't ask, you don't get. So you may be getting a decent deal, but could be a lot of savings there that we could still find for you if the incumbent was to be challenged. We've had a few instances where one of the largest banks in Canada is coming to the table very defensively on deals. And that's can be a good result for a client. But it's funny because oftentimes the client's like so mad at them for not bringing that forward before we were involved that they want to switch anyway. So anyway, it's a very interesting landscape.
Cool. I'm very curious to hear how it's going for business in general out there, because, with the interest rates jacking up as fast as they went, as quick as they went, as a knee-jerk reaction to the inflation that went out of control as a result of the government printing and spending untold amounts of money and dumping so much more money into the marketplace, which you can tell exactly how I feel about all that, for the tone of my voice. You create the problem and then you create a problem on top of that to fix the problem, but it creates a bigger problem because now business owners have to contend with these high interest rates, and access to capital was becoming harder and harder. Like, it's becoming more and more difficult. Like, I share this quite often on the podcast, and it's like, I'm not here, talking about rainbows and unicorns, and that being a business owner is all, it's all wonderful. Everything's great. Mickey Mouse is jumping out of every corner. It's not, man. Business is hard. It's hard running a business. You've got 4,000 things to worry about. You're trying to stay on top of compliance. You've got HR. You're trying to keep your clients happy. You're trying to acquire new clients. Then you've got inflation running off on the, off the tracks, and you've got demands from employees that, like, the labor shortage is huge. That's a major problem, trying to find people just to work for you. So now it's like, oh my gosh. And then you throw inflation on it, interest rate increases. And then you're like, crap, I need to get some more financing, or I need to get some more cash. And you've got a squeezing of the belts, shall we say, from the traditional lending institutions. Now you're really screwed, And so, this is why I want to bring people like you to the audience, for the people to hear about it, saying, but did you know that Lakepoint Capital existed? Did you know that they can come and help you find financing? They can help you get that financing, and the same thing we say to all our clients is, like, if you're looking to get financing, call us first, call MBA first, call us. Then we go, hey, guess what? There's these great guys. I need to introduce you to Brian. Brian comes to and again, it's a relationship thing where the client comes in and goes, I can't get money here, and here. What can you do to help me? I said, you know what? I'm the first one to say the expertise is not with us. It's with Brian. Go see Brian. Right. And so, what are you seeing out there in terms of access to capital? Are you seeing it more difficult for businesses to find it? And how much harder is it for you to find it for them?
Well, I think it's interesting. When Cooper and I started this, when we were first talking about it, let's say, actually, the idea of the business, it was a very different interest rate environments to what we ultimately stepped into when we launched. And but what I'll say is, as much as on the one hand, that was a bit of took some wind out of our sails. On the other hand, it actually was a bit of a boon in that because capital is harder to access, because debt is harder to get, it makes our services that much more valuable for businesses when it comes to, okay, we want to make sure that we are getting the lowest cost of capital out there because of how constrained the economy is becoming and challenged and the challenges that we're facing. So there is a lot more value that we can bring to the table when money is not free and easy and flying at everyone from all corners. Again, to emphasize, it's working with clients that are in need of new facilities because they're looking to acquire, to grow, to facilitate a buy-in, or it's just they have an existing facility that they want to optimize, and that's where we can come in and add value. What's interesting also from a challenge perspective, I think, when it comes to clients going out into the market themselves and trying to access capital, is it's a bit of a theme with conversation, but that relationship piece. I've had conversations with clients where they've said they may have been with one institution for quite a long time, and I think in those instances, I think there's a perception that, oh, well, if I'm loyal, then I'll get some benefits, and I've been with this institution for over a decade, and they know me and all this kind of stuff. I had a conversation with a client we were talking to, and he'd been with a certain institution for, it was 10 years, and he'd had 12 different account managers in that time. And so that turnover is pervasive in the industry right now. If you're a good banker, it's often the case that you're going to be either moving laterally to different institutions because you're getting headhunted, or you're moving internally up the ladder and out of those roles in order to kind of move up the ranks. And as a result, clients are the ones who suffer from that because you have this constant influx of new faces and less experienced individuals trying to fill roles that COVID in particular created a lot of vacancies in, because there's a lot of experienced people who retired, a lot of people who decided, you know what, I'm going to hang up the hat now. And so you have these senior account managers at different institutions that normally would not necessarily have that label. And so it's incumbent upon us, again, to identify who the best people are within the institutions that we have available to work with, but also make their job as easy as possible, because they may not have the ability to look through the complexity of a deal unless we're able to walk them through it in a streamlined fashion. So you're saying about the revolving door of people looking after your file. That used to drive me nuts when I had my banking relationship. It was like, here's a new person, and now you got a new person, and then you phone and that person's gone, and you're like, well, where's my new person? Oh, you don't have a person. Oh, great. Kind of like doctors. Like all of a sudden you don't have doctors and they're gone. Right. And I mean, I can mirror this kind of to, again, from my experience, because, having been in the accounting profession for 35 years, it's 35 years now. Wow. It's having a different person on the file for the client pisses the client off. Every time they get a new person taking care of their file and asking the same questions that the person asked last year, and it drives the business owner crazy, going, look, I'm trying to run my business here, and you're asking me the same list of questions the person asked me the year before. Go ask them, right? And so you have this discontinuity of people. But when it comes to the access to capital, I mean, are you seeing more businesses coming to you saying, like, we just can't find it? Like, we can't find the access to it? Or is the service you provide so hyper niche that it's like a different area? Like, I'm trying to just hone in exactly who the perfect client here is. No, I see what you're saying. And again, if I had to give some parameters for who kind of the ideal client is for us, it's really like the clients we work with are very, very bankable. So so they already have an existing relationship. Here's an example, the HVAC industry. Very recurring, stable revenue, very diverse customer concentration. There's always going to be a need for either the maintenance or new installations. And so they have a very kind of robust and multiple different service lines type of thing. So there's a lot of banks who will trip over themselves to get a client such as that in the door. And so we exist for HVAC businesses, as an example, to ensure that of all the banks that would be interested in working with you, you're getting the absolute best terms out there for whatever your needs are. And sometimes that's because they want to acquire a smaller HVAC company and bring them into the fold, or deploy a roll-up strategy, and they want to have some pre-approved financing that may be available for that. And pre-approved financing and dry powder is very difficult for banks to wrap their heads around, because they want to have certainty as to, okay, what is this being used for? What is it being used when? We don't want to have just this money sitting around kind of available for whatever. It's difficult to get. So one example actually from one of the clients I mentioned previously, they again, with the 10 million in revenue each year and looking to expand locations, we were able to get them pre-approved financing for 3 new locations that they were going to open, that there wasn't determination yet on necessarily exactly what amount was going to be needed and where and when. But that pre-approval is huge, especially if you're in the context of looking to acquire entities. Because if you're able to make an offer on a business, again, with the upcoming decade of business transitions that we're going to see, if you're able to go to a business owner and say, I want to buy your business, here's the structure that I'm proposing, and by the way, I already have pre-approved financing, so we don't even have to worry about that, or at least for a portion of the purchase price. That's going to be a big sell for that seller to want to be interested in doing that transaction, versus someone coming and say, hey, I'd love to buy your business, but I don't got anything prepared, and let's hope this works, and let's see what happens, and let's waste a bunch of your time trying to figure it out. So, yeah.
Right. And I see that. So for the listeners out there, if you're thinking, okay, are we the right fit for Lakepoint? If you're looking to buy a business, and here's the huge opportunity, you mentioned it earlier in the podcast, that there's a big mass exodus coming. Like they got the baby boomer bubble. They're leaving and there's going to be so many businesses for sale. So the M&A space is going to be massive. It's already starting to trickle and it's starting to happen where you're going to have a lot of opportunities to buy. So if you're sitting here and you're going, I'm thinking of acquiring a business, I think I'm coming in there. I mean, a great opportunity, or expand by acquiring another business. Having a pre-approval in your back pocket is so valuable. Like you come walk into a potential acquisition and you tell them, look, we're already pre-approved. We've got the financing behind us to buy it if the deal's right. All of a sudden they're like, okay, this is now let's get going, right? You're going to be way more attractive. And you have that dry powder. So here, I want to kind of get to like some terra firma here for the listeners, right? Like in terms of what are some say opportunities that are sitting there right in front of them that they don't even know about, right? Like that could potentially help them get access to some financing where they think, oh, I'm not bankable. So say you said that before. Oh, they're very bankable. They have all that. But let's say they're sitting there go, well, maybe I'm not. And you're like, well, for example, you've already given us one, which is it's not necessarily the asset based, but it could be a cash flow based lending facility you can get. But it's a matter of the client doesn't even know that they can do that, right? That you can get lending based on cash flow. What are some other odd or that you may seem as like bread and butter that we could kind of say, hey, look for X, Y, and Z in your business and go, wow, actually, maybe I could borrow more money and there's a way to do that. I need to go see Brian, but we need to kind of let them know if the opportunity is even there. So that one of them is cash flow based lending. What else have you seen?
Well, I think an important thing for people to keep in mind, and this is going to sound like a very reciprocal plug, and I guess it is, and wasn't intentional. But at the end of the day, like having good accountant is worth its weight in gold when it comes to a client being prepared for any sort of financing or acquisition event or sale event, frankly, because having financial statements prepared and not even just prepared, actually I want to go much beyond being prepared, but having financial statements and having advice with respect to how your operations are being run is super important, because when you have clients who, for example, entities that may be on the say smaller scale, often will run personal expenses through their business, and there can be some tax advantageous reasons for doing that. But there can also be some negative implications that can have from a debt to EBITDA perspective, and being mindful of what you can do to position your business in the best way possible for lending includes being mindful of, okay, let's make sure that I'm working with my accountant to structure things so that we're not just preparing ourselves for a world of hurt later, even though there's a kind of short-term benefit for how we're operating right now. Having consolidated financial statements amongst different entities is very useful as well when it comes to that financing piece, because often what we find is it's a time constrained event when we're being I've had multiple conversations this week with clients who are, or I should say prospects, who are interested in working with us, but not quite yet. We're looking at restructuring next year, or we're looking at doing an acquisition of commercial real estate, but not quite yet, or we're just starting to look and have a realtor looking around, or not the financing piece yet. So there's that time element of things. And when we get to that timed event, it's becomes very much a pressure situation if things aren't organized properly. The better things are organized, the more smooth that process can be for them. So I know your question is more orientated towards what's some kind of creative, maybe out of the box lending facilities that may or may not be available. I think the diversity that exists when it comes to the debt space is not limitless for sure. Ultimately comes down to a lot of kind of risk factors and what is serviceable. But that's, I think, the best comment I can make for a client is to assemble themselves with a very strong professional advisory team that on the accounting side is not just backwards looking, and on the legal side is not just liability looking. You want to have lawyers and accountants who are looking forward at, okay, what is the actual plan here, so that we can, we don't want order takers to be the only function that these professionals provide. So on the legal side, obviously I have a robust network in that world, and I'm more than happy to make recommendations to clients when I see that maybe they don't have the legal support that is as robust as their business may now necessitate, because they may have started with a lawyer that incorporated their business at a small firm. And not saying that small firms can't provide very robust advice, but maybe this one doesn't have the bench strength that it may need in order to carry the business through to the next growth stage. And so I think it's incumbent upon us as advisors to be mindful of what that advisory circle looks like and make the appropriate recommendations. Because there's a lot of value that can be derived for clients when they have someone who, you go to a lawyer as an example, and it's not just, I need a shareholder agreement, and they just pick something off the shelf and say, hey, here's your shareholder agreement, but actually ask, why are we doing this? What's the rationale behind it? What sort of things do we have to consider? Because one of those things that may be in that shareholder agreement is, we need unanimity on getting more debt, and there's a variety of shareholders involved, and one person could kind of stymie that whole process. So.
Yeah, you said something there which is very much in alignment with MBA and the way we look at our clients' business and their lives, because it's not just about their business, it's about their lives and where you want to go. We have this approach called the 4 planning pillars, where we look at their business, retirement, wealth, and estate plans, and making sure that we're aligning and structuring everything that's going to help them get there. And so those, you have someone come in and they're like, I want to write off everything I possibly can. I'm like, okay, well, that's going to screw you for borrowing in the future, because I know you want to borrow to buy this condo at Mount Washington or up at Big White, and you're going to need some personal income because you want to hold it personally because you want to leave it to your kids and blah, 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 whatever. Like, the whole thing is a labyrinth of what you want for your life, and what each professional is doing will either support that, bring it closer, or it will hinder it and take you farther away from your goals. And so, I think all the things that you've just said there is like what we do in MBA. It's like, okay, what is the thing that you're really trying to accomplish here? And then we can talk about the structuring. Then we can talk about what to write off. Like, there's 3 things I said, like, there's ownership structure, compensation strategy, individual personal compensation strategy, and tax efficiency. Those 3 things, that's the 3 things that we do technically. But they have to provide the right base so that the client gets to where they want to go. Not go and write everything off and then they show that you've got a company that's worth nothing. Especially, like, say you're going to do a sale, and it's like, okay, you're writing off everything under the sun, but when you go to sell this company, you're going to have to normalize the income, and it's going to be such a huge shift. They're not going to trust that your income is really that much. Plus, you're going for all the risk and all the rest of it with the CRA, and it's just a nightmare. So I just want to encapsulate that, just so our listeners can kind of go, okay, well, what exactly should I look for? So one of the things you said, number 1, keep your house in order. Yeah. So in other words, keep your financial statements strong and have the right advice, have the right professional team in place that's helping you get to where you want to go, so that when in the future, if you want the financing, we know what we're setting up for. We're getting it ready. That's why I'm really looking for, Brian, is for you and Peter to start working on some deals together and to see, exactly how we work and how you work, and we can make some magic happen there, right? Because then now we have professionals working together at the common good of the client, which is, what a concept, right? Like, what a concept to make that happen. Yeah. So I just want to cover this off. So number 1, keep your house. And number 2, watch what you're writing off. Don't write off everything under the sun, because again, it ties into that first part. And the last thing that I just want to put out there for the listeners, the third thing is, like, there could be some untapped assets within your business that can allow you to borrow the right type of debt for what you're trying to do in the future. And the key here is for you to go, if you're not sure, pick up the phone and call Brian. Like, there's the end all to be all. Like, I instead of giving him a laundry list of all the things to think about, you're saying, Eric, there's so many different things you could potentially be borrowing against or having within the company that could support a lending facility that's going to work. Not only can we find that for you, we will structure it and present it properly to the right lenders to get you the debt that works for you, to get you to the future that you want.
And I think that's a great way to phrase it as well, the future that you want, because as we talk about debt, so commonly we are talking about, okay, what's the interest rate I'm paying? What are the fees associated with it? What's the the quantitative cost to things, which is super important, obviously, for any business and any business owner. But another thing that we found when it comes to clients and educating them about this process, and it truly is education, because at the end of the day, again, we're working with business owners that this is not necessarily their first debt event, but it is still only one of a maybe small handful of debt events that they've ever been a part of, because they're busy with the day-to-day of their business, because they are trusting that they're getting the best deal brought forward to them by their existing lender. And they're not looking at term sheets, like I mentioned, every day that like we are. And one of the things that we found that's been so interesting is we have a few different clients that we were talking about right now where the differentiating factor for them amongst different lenders who are coming to the table is stuff like personal guarantees, is stuff like, am I going to be restricted on dividends that I'm able to take out from the business? And that's been huge, because when you have a business owner being told by a third party, a lender who again, all respects to bankers understanding businesses to an extent, they aren't business owners themselves. And so when you tell a business owner, hey, we're going to give you this money, but you can only take out $100,000 a year, or you can only take out $150,000 a year, and that is very, just intrusive, frankly, for a lot of business owners. And they don't want to be told what to do when it comes to that distribution side of things. So I raise these things as kind of points for consideration when it comes to just the qualitative elements of debt, what the flexibility is of those terms, what sort of reporting standards are they going to be held to, how often are they going to have to be asking a bank for permission to do X, Y, or Z. So that's really, again, where we're able to come to the table and support a client, because they just don't know necessarily to even ask about those things, or what to ask for, what's even possible, kind of thing. So that range of possibility is where we step in.
Yeah, I think we put a cherry on top of this one for the entrepreneur. It's like for an entrepreneur to be controlled and told what to do is like a death sentence. Don't tell me what to do. I became an entrepreneur so that I could create some value in the world. I could run my own business, have my own say. And then you go and get a lending facility where now they're controlling you and telling you what you can or cannot do. And I'm sorry, but most lending institutions are bureaucratic organizations. There's big bureaucrat machines, and entrepreneurs are trying to create more value in the world. And so, if you want to find out, ask my wife. She's like, if you say, hey, Aaron, how do I get Eric to not do something? Well, then it's simple. You just do the opposite. So if you want Eric to do something, tell him to not do it. And then I will do it, because you've told me not to. So I'm going to go against that. And it seems to be ingrained in most entrepreneurs. It's like, don't tell me what to do or what I can or can't do. And so being hogtied to your debt financing stops you from getting the life that you want for yourself. And that was the whole point of being an entrepreneur in the first place, is to have the freedom to create some value in the world and do it in your own way, and to get compensated for that and create jobs. And it's all the things that kind of tie it in together. But to have yourself hogtied to your debt is a major pain in the butt. Or when you're trying to explain to the bank, hey, it's better tax efficiency wise to pay ourselves this way versus that way. And the bank's going, yeah, no, you still can't do it because it doesn't fall into the template. You just want to bang your head against the wall and go, come on, really? Good. Let me have this.
Maybe we should think of a tagline. Don't be hogtied by your debt. Maybe that'll be the Lakepoint tagline.
Hey, I'm here to create as much marketing material for you as possible, my friend. Is your debt working for you? And don't be hogtied by your debt.
Yeah, sort of graphic design. We can get going on that. But
I like that. Okay, so this has been a great conversation, Brian. I really appreciate this. So people can find you at
lakepointcapital.ca. Send me an email at brian@lakepointcapital.ca. Give me a call at 250-859-4394. Pretty accessible. Find me on LinkedIn. It's not hard, but I really appreciate you taking the time to have us, the royal us, out on the podcast today, Eric. And enjoyed this.
No, this has been great. Thank you so much. And most importantly, enjoy the sleeping, the eating, and the pooping, because your daughter will not stay that little for very long. My kids are now 24, 22, and 12. And it goes by so fast. And I'm starting to sound like everybody else in front of me that had kids. And I go, you better enjoy it while you can, because they're going to grow up fast. And you're like, yeah, whatever. And then all of a sudden now I'm the old dude. I'm the OG saying that to you. So I'm doing my duty. And then when you get to that point, you get to say it to the next one. But please enjoy those three things: the sleeping, the eating, the pooping.
Correct.
Enjoy that. All right.
Thanks, Eric.
Okay, thanks, Brian. Bye. If you're a business owner or CPA who believes the accounting profession has let you down, then please reach out to us at www.mbacpa.ca so we can have a chat to see if we're a fit to work together. We're always looking forward to talking to you. See you next time.